Everybody, I'm Christopher Tipper, CEO and founder of Hunter Benefits Consulting Group, and I would like to thank you very, very much for joining our monthly webinar series. This topic today about cash balance plans is our most requested. Now, I've been dealing with defined benefit plans of some sort for 37 years. The goal today is share most of that knowledge with you in the next 15 minutes. So let's see if we can accomplish that. But before we get going, we are going to ask you to answer a very quick three-question survey. Please type your answer to the chat. How confident do you feel about suggesting a new cash balance plan to a prospect or client? One, not confident. Two, somewhat confident. Three, pretty confident. Okay. Now we have a pretty heady learning objective for this webinar in 15 minutes plus 15 minutes of Q&A. You may be wondering how I'm going to be able to accomplish all these goals in 15 minutes. You are going to get a very high level view of some very key concepts that will help you get on your way. We will review those and then spend as much time on the detail as time allows. But please remember, you're all going to get the slide deck afterwards, and you can always get in touch with us via email later on for some very specific questions. So now then, we're going to discuss how cash balance plans are different than defined benefit plans, give you an idea of what the ideal candidate is, talk about comparing 401k plans with cash balance plans, because I think in the past 20 years, I have put on two cash balance plans that were not coordinated with a 401k plan, and those are very specific situations. It doesn't make sense not to. We are going to talk about some of the key actuarial and compliance rules and talk briefly at the end about some common design mistakes. Now, why cash balance plans matter and why they need to be your friend. Much larger deductions. All right. If you're putting this in front of your client or prospect, that means somebody else can't. It's going to differentiate you. This can be a very, very valid solution for high income earners. And I love my boomer brethren or siblings, I should say, who are very slow on saving for retirement. And this is one way to get things pretty well caught up. But please also remember, ERISA is definitely a part of this. We've got to follow more rules than we're used to, okay? Or I should say more rules than with 401k plans. So we're going to begin. All right. Now then, this is how I try to think of things to help explain things at the beginning. Our friends at the IRS have given us two primary ways for employers to save for their retirement and their employees. The first one, okay, is the first one has a take. So each one of these has a give and a take. For the first option, the take is a relatively small dollar amount that can be contributed each and every plan year. I said relatively small. Now then, the give is that it's completely discretionary from one year to the next. What you do for one plan year has no bearing or impact on what you do in later plan years. Our second option has a different give. That give is a large dollar amount. The amounts that can be accumulated and deducted are substantially larger or can be substantially larger than option number one. So that means that the take is that this is a multi-year commitment. You have to make a commitment to this. There's much, much, much less discretion. Notice I did not say zero discretion. Okay. Now then, if you haven't guessed it already, the first option is our good old friend, the 401k plan. And the second option is our new friend, the cash balance plan. All right. This is about as simplistic of a view as you can get comparing a cash balance plan to a 401k plan. There are some things that we need to think about and when we're designing the cash balance plan. And since we have to be worrying about them on the compliance side, you need to have an awareness of them on with your prospects and clients to see who it's going to make sense for. Now then, the owner only is probably the simplest. All right. One owner, not worrying about the cost for the rank and file. All right. Lowest expenses all the way around. Obviously, 100% of the deductible contribution goes to themselves. Much easier to do the plan design, etc. However, we have, that's not to say that a situation with one owner and one rank and file employee who's full time is not a good situation. Now, one thing that you have to remember, especially if you've been doing 401k plans for a while or have been involved in the defined contribution market since 1996 or sometime thereafter, all right, you cannot have a defined benefit plan or a cash balance plan for only one person if there are two or more partners in the company. If you have a firm with two owners, you need to have at least two people benefiting from that. You can't just have the one. Now, the second one doesn't have to benefit at the same rate as the first one, but there has to be some kind of meaningful benefit. I'm mentioning this because I've run across numerous financial advisors who've told me about law firms with two or three partner law firms, no employees, and they're very happy that they have put in one plan for one owner, and that is not something that's allowed. Now then, we can't forget our friends at the PBGC. Okay, there are advantages to being part of the PBGC, but if you have obviously owners, owner-only plans are not covered by the PBGC, but if you have a professional corporation that has 26 or more employees, or an entity that is not involved, that is not a professional organization like a doctor, a dentist, lawyer, architect, things like that, they will need to be covered by the PBGC. And also, there is a gray area of certain financial advisors are sometimes covered by the PBGC and not, and the same thing with life insurance agents sometimes covered. Now then, the big difference between the PBGC and the non-PBGC plans is that if you're not subject to the PBGC, such as an owner only or a small medical practice, the employer contribution limit to the 401k plan is only 6%. If you're covered by the PBGC, it's 25%. And also, because the employer is going to be responsible for the accumulation, I mean, they have to offset any losses in the plan by contributions. Please pick the lowest fixed rate in the plan design that you think you can accomplish. We're going to talk about that a little bit more in a minute here. Now then, some key concepts that everybody needs to know. These are very, very important and really get people confused. Your annual accruals after the first year, okay, how much you accrue as a benefit does not equal your contributions. All right. Just because somebody has an opportunity to make a larger contribution one year does not mean that the benefits are more. Okay. Also, by the same token, if they've been funding the plan sufficiently for a number of years and they have to make perhaps a minimum required contribution for 1 year, that doesn't reduce future benefits. All right. It's going to increase your future contributions, but there is not a one-to-one relationship between contributions and total benefits available. The other thing is you're going to need, if this is your first time talking about a cash balance plan, you are going to need to think differently about what your goals are and how you want your client to measure you. Okay, what I mean by that is you're looking for singles, not grand slams. All right, because your employer client is responsible for all the risk in the plan. All right, you're going to want to make sure that you're looking for 3 to 5% as your annual rate of return. If you get a 26 or 29% home run 1 year, you may put the client in a situation where they don't get to make a deductible contribution, or if you lose 30% of the plan, they're going to have to make a much larger contribution. Now then also we got two more things here. There's no employee direction. Yes, in an owner only, the plan trustee, the plan administrator is the employee, but technically the way the IRS looks at it, the trustee and the financial professional are making the investment directions, but there is no concept of employee direction. Also, if you have a situation where you have a prospect or a client with more than one owner and each of them wants to have their own financial professional, there's nothing wrong with that, okay? But they do not each get to have their own rate of return. We are going to look at the aggregated rate of return, okay? And that is what's going to be used in the plan. All right. There's going to be questions later on, but if anybody wants to, are there any questions, guys? Nothing showing up right now?
And I think there's a sixth concept, right? So
Pardon?
a sixth
Thank
con
you. Yes. Oh, golly, I already forgot. Thank you, Amanda. All right. Now then, those of us who have been around for a while, we keep forgetting the fact that the secures have given us something new to play with. It is not too late to start a cash balance plan for 2025. Okay. It's a big, huge requirement that your prospect or client has extended their return. Now, because the funds need to be deposited by 9/15, okay? They have to be in the trust by September 15th. We can't wait until September 14th to start the plan. The actuaries are asking for the first week of August as pretty much the last time to set up a plan for normal fees for 2025. Just expect the fees to go up because the rush fees the closer we get to the end of August. But we can set up a cash balance plan and the appropriate profit sharing component for it as well for 2025 still. Thank you very much, Amanda, for reminding me of that. Okay. Now then, we're going to get hopefully this was the brief overview. Hopefully you found this helpful. We are planning on later on in the year having a deeper dive into exactly how or why we design the plans the way we do. Now then, actuaries get kind of annoyed with me when I say it this way, so I'm hoping we don't actually have an actuary attending right now. But it's not unreasonable for you to think of a cash balance plan as a money purchase plan on steroids, as long as you remember the fact that contributions do not equal benefits. Okay. It is the most important thing is to remember with a cash balance plan is the name of the plan type. And what I mean by that is it's a defined benefit plan. When you stop to look at that phrase, defined benefit plan, it actually tells you everything you need to know. The benefits and the interest crediting rate in the plan document, they're defined there. They're going to let you know each plan year what the total accrued benefit's going to be. These benefits are not affected by the asset value. So what you're going to have is an annual pay credit amount that's going to be defined in the plan. It's either going to be a flat dollar amount or a percentage of current compensation. And you're going to have a set interest crediting rate. That's what the employer is guaranteeing the participants that the benefits are going to grow at that rate. The larger the interest rate that you set, the smaller the deduction, the smaller the interest rate, the larger the deduction, and actually the larger the benefit. Okay. And obviously, these are all governed by ERISA and have to be signed by the contribution amounts have to be approved by an actuary, et cetera. Now then, very quickly, all cash balance plans are defined benefit plans. Not all defined benefit plans are cash balance plans. Now, while cash balance plans still offer the same lifetime monthly incomes, they seem to be more commonly available with lump sum distributable amounts as opposed to your traditional defined benefit plan. One of the very key, so there are some very key selling features about the difference between a cash balance plan and a traditional defined benefit plan. The first one is that the cash balance plans coordinate with a 401k plan much better than a traditional defined benefit plan. We're going to show that the next time we talk about cash balance plans. All right. We set the plans up so that most of the cash balance benefit goes to the older owners with what's necessary to meet both the employer's wants and needs and the rules as a smaller benefit in the cash balance plan. And then we make things pass by having larger contributions for the rank and file in the 401k plan. Okay. So you've got, and that works out to a tax advantage. We get to leverage the contributions for the employer's benefit. Also, if the employee wants to have a lump sum distribution, because most of them do, what's better for the plan sponsor is that the accrued benefit that they see on the last valuation is going to be very, very close to what the participant is paid. The reason why I say very close is because if you're paying them out 3 months in the following year, you've got to give them 3% of that 3, 4, or 5% crediting interest rate that we were talking about before. The big difference between cash balance plans and the traditional DB plans is that the traditional DB plans are usually some percentage per some year, whether it's employment or participation, and then it's multiplied by some average, usually some average compensation formula, either the highest three, the highest five, or the last four. There's a variety of different rules that you can do there. Do we need to take a where are we on the Q&A part? Would we like to start asking some questions now? Can't believe we got a quiet bunch. Nothing in the comments there, Amanda?
No questions
Okay.
yet.
Okay, I guess I'm doing perfectly. All right. Now then, who are our who, who is our key or best prospect? Most people think, because of how the math works, that best the best candidate is a 55-year-old because there's some math in there. That's the oldest somebody can be to have the maximum accumulated by age 65. Okay. And what they're looking at is just the most amount that somebody can put away. But now, for the sake of conversation, we're going to take out the fact that that we have the annual maximums that people can take out of the plan, not put in, take out of the plan, do go up each year or almost each year as the maximum compensation amount goes up. Okay, but if we take that part out of the equation, what's the difference between a 55-year-old starting a plan and a 25-year-old starting a cash balance plan? I'm not being silly here. Okay. Um, if you discount the fact that the maximum limits are going to go up, it's a defined benefit plan. The lump sum that they can accumulate is going to be the same. But if the amount you can accumulate is going to be the same, and the difference is one person's putting it in over 10 years and the other person's putting it in over 40 years, what's the big difference? Well, one, you're only going to have 10 years worth of gain versus 40 years of gain. All right. Not trying to be complicated here.
Christopher, you got some questions in the comments.
Okay, what do we got?
We have two. One says, can employees elect a monthly payout like a traditional pension plan? And the second question is, can you make the retirement age later than 65?
Yes, because a cash balance plan is a type of defined benefit plan, a monthly income amount is always an option. Okay. unless, as long as the accrued benefit is more than $7,000, because the force out rules apply to cash balance plans as well. We've had it happen once or twice in the past couple of years for the first time in the history of my company. It's generally um, even though with interest rates are higher, it generally costs the plan more money than the lump sum, and they are mechanically a pain to make happen. But yes, they are basically a federally mandated option. Okay. And then what was question number two, Kaylin?
Question number two is, can you make the retirement? Oh, you answered that one.
No, not the retirement age,
Can
65. Okay.
employees elect a monthly payout like a traditional
Yeah, that was
pension?
the first one. Yeah. And then the other one is age 65. Okay.
Yes, and we just got
So
another question
let
coming
me
in.
answer the
Okay.
retirement age first. So, no, it depends. Okay, the maximum, the latest you can set somebody's normal retirement age is age 65 and 5 years of participation. And we've got to pay attention to required minimum distributions. Okay, so theoretically, if you have somebody start at let's say here, age 68, they start the plan. Normal retirement age is going to be age 73, just before MRD. Now, with the exception of the employees or participants who are subject to minimum required distribution amounts, there's one thing we need to remember about normal retirement age inside a cash balance plan. It is simply a date upon which we do math. If you are older than normal retirement age, that does not mean you stop accruing benefits. That does not mean you have to you have to take your money out. No, we're just using that to determine what your future accruals can or need to be. Okay. So if you have a rank and file employee who's 84, well, it's going to be kind of expensive, but they get to continue to accrue a benefit as long as they're not at the 415 maximum. And what's the next question, Kaylin?
This one sounds complicated. I'd love to know the answer to this one. At plan termination, does the employer need to conduct a risk transfer to an insurance company for employees or those in monthly pay status?
Um,
And there's another one that came in after that.
okay. Well, somebody stayed up late asking a hard question. Okay. So what's usually going to happen with that, we have only one plan in our book that is not a cash balance plan. It's a traditional DB plan that is in a monthly payout status, and they're basically going to have to keep the plan going to make the monthly payments. What normally happens with a cash balance plan is the trustees bite the bullet and buy an annuity to fund that lifetime income. So that benefit is no longer part of the plan. Okay. We have um, we have not had any terminated plans want to take a monthly income amount, but if that were to happen and there was not enough assets to fund the owner's benefit amount, they can at that time then take a smaller benefit. What was the next one?
How do the advisors generally approach hitting the return bogey? For example, if the target rate is 3%, why not just buy a 1 year CD for 4% and call it a day?
Exactly, 100%. Okay. We're presuming th that's what we're looking for. Okay. Now, the one problem with just having did you say CD, Kaylin?
Yes.
Okay. We may need to have some liquidity. Okay. So as long as you have the ability to, if you have a rank and file employee whose accrued benefit is maybe $15,000, as long as the employer has the possibility of maybe making a $15,000 contribution and then paying out that participant, because that's going to count as a contribution for the plan, that's exactly what we're looking for. Now, do remember though, because you guys are starting to ask harder questions, we're going to start giving you hopefully more nuanced answers. The first year of a cash balance plan there is no interest credited amount, okay? Because the benefits are deemed to be accrued as of the last day of the plan year. So for a 12/31/2025, because we're hoping somebody's going to start a plan for 25 still, for a 12/31/2025 plan year end, the benefit is accrued on 12/31/2025. So there's nothing to accrue a rate of return on. Okay, so let's say it's 3% and one person has $100,000. So that means on 1/1/26, okay, that $100,000 is going to earn $3,000 for all of 2026. But your employer may not have made any deposits in 2025 and may push the required contribution all the way out to September 15th. So even though you've got a 4% CD, okay, it is not going to have earned 3% from September 15th through 12/31. Okay, so we need to keep that in mind when we're looking at the rates of return of specific instruments being bought, and keeping in mind that that instrument you're buying is earning that rate of return from the day you buy it, but we're doing our actuarial calculations as of the first day of the plan year. Okay, next one. I'm seeing
Two
questions.
more. How long do cash balance plan need to be in existence before terminated? I think I know the answer to this one. Can I answer it?
We're gonna let you try.
Is it 3?
Well, okay. So that's the answer we use. Unfortunately, well, this is a recorded line, so we've got to put a whole bunch of caveats on this. Okay. This is the, remember we're talking about the commitment at the beginning. Okay. It does not say anywhere what the definition is of permanent and ongoing. Okay. It's not defined anywhere. Generally speaking, I don't know if I can be more vague than generally speaking. Okay. The IRS is not too upset if you make discretionary changes after 3 years. So 1, 2, and 3 are the same. Year 4, you make a discretionary change, et cetera, et cetera. That seems to meet the current definition of permanent and ongoing. Okay. However, that's a discretionary change. If you have a valid business reason to make a change to the plan, that's completely acceptable. We had a plan subject to the PBGC that was intended to go on for 5+ years, but PE-backed buyer showed up out of nowhere in month 18. That plan shut down within 24 months. Okay, since the employer no longer exists, that's a valid business reason to terminate the plan within the 3 years. So hopefully I'm giving you some idea as to what we're looking for.
We've got another question.
Yep.
Have you run into meaningful benefit issues with smaller cash balance plans? And how are you designating staff rules to stay compliant without overpaying? There's so much testing, right? I mean, that would be one part of the answer.
Okay, you do not say in public, but you're gonna have to let me know who asked that question. Okay, so this is what we're talking about with the meaningful benefit. That's 401(a)(26). That's some formula based on, I think it's 0.5 of something. Okay, I just let the system calculate it. We're technically in the time. I'm going to stick around for a while as long as you guys want to keep asking questions. I'm going to do my best to answer them. Now then, there's a couple of ways to accomplish this. All right. With Robin, it was the last. So we've got 2 ways of handling this. The last mandatory and amendment restatement cycle was for PPA, right?
Yes.
Robin, right?
Yes.
For cash balance plans, it was PPA, not cycle 3. They're off. They're not on the same cycle. Okay. And with that one, we were given the option to have somebody's benefit accrual rate be calculated along the 401(a)(26) lines, which is the meaningful benefit calculation. All right. So in the case where we've got a two-person law firm, and one of them is 55 years old and the other one is 35 years old. I'm making stuff up here, folks, okay? And the 55-year-old wants the maximum benefit, all right? They're going to set up a benefit for the maximum 415, and the younger partner is going to be set up because they want as little involvement as possible. They're going to be set up for the minimum meaningful benefit. Now, that amount, we're not going to have to make any changes to the plan document. It's always going to be correct. But as that person ages, that dollar amount of that benefit is going to go up. Now, then, what we do if an employer does not want that provision in the plan, um, once a year, the actuary is going to let us know because they have a method that they deem reasonable. We are going to have these two or three participants receive a benefit increase, or maybe just get one for just that year. Okay, so it's not been because the amounts are small in relationship to what the owners are taking. It's generally not been problematic. There are some the times when we have issues aren't the dollar amounts. It's always, why do you have to give it to that person? Can't we give it to that person? No. Okay, because the actuary has their methodology that makes it, per their eyes, more fair. Next.
Uh,
Hopefully that answered. And if you guys,
that's
obviously, somebody call BS if you think, I don't think I'm making stuff up, but if you're disagreeing or confused by my answer, sales@hunterbenefits.com, or let us know, or ask the question again.
that is actually the end of all of the questions.
Yay. Okay. So we're technically over time. So thank you. We started 2 minutes. Well, we started about a minute and a half late and went over a minute and a half at least. So I would like to thank oh, hang on a second here. We need to go to, so very quickly, the cash balance plan advantage, lots of money you get to put in. You get to leverage that with your 401k plan. Yeah, you still got to comply with ERISA, but this can help you really distinguish yourself with your clients. Okay, and for those of you who are still left, this is how you grade me. I hope I did an okay job. So after this, are you more likely to bring up a cash balance plan with a prospect or a client? Okay. And if you are now, hopefully not, but if you are now less likely to bring this up with the prospect, please reach out to me directly. I will talk you off the wall and we can help you figure out how this makes sense for everybody. Okay? So if you guys would please vote, so to speak, with the comments. All right. Oh, one more. So forgive me. So next month, we're going to have some of our friends from Fidelity on. After that, in July, and yes, our every Wednesday, you'll notice in June it's going to be on a Tuesday. Okay, we have a fiduciary expert, and he does call himself a fiduciary expert. He goes to court to testify and opine on fiduciary issues for ERISA plans in August, because we're running into the safe harbor, setting up a safe harbor plan for 2026 deadline. We're going to have some friends at American Funds. And then in September, I'm going to be talking about what it means to be a 316 fiduciary, what you're looking for, and what maybe your maybe reclassify some expectations and things like that. All right. So thank you very much, everybody, for showing up and for hanging around with us. And I hope this made sense. So take care. See you guys next month.